Welcome to our pre-budget Economist Roundtable. Here's a CNBC TV18 poll of what top economists are expecting in terms of their income, expenditure and deficit. The income growth of the government will depend, of course, on the economy's GDP growth. The TV18 poll sees India's nominal GDP growing by around 10%. I mean, this is the average. That's for FY24 versus 15.4 this year, FY23. Net tax revenue of the government is expected to grow by the same pace as the nominal GDP. That is about 10 to 10.5%. On the expenditure side, two items economists say they're going to watch. One, subsidy, that is seen falling from about 5.7 trillion in the current year, trillion rupees, to about 4 trillion rupees because free food amounts and fertilizer prices are going to fall. Capital expenditure is the other number they're all going to watch, budgeted to grow by 25% this year. The expectation is it will be budgeted to grow by a slightly slower, maybe 15% next year. That is from 7.5 trillion rupees that the government spends this year to 8.7 trillion thereabouts next year on capital expenditure. Finally, most important number, economists want the fiscal deficit to come down. The average I got is 5.8% from this year's 6.4%. The central government is expected to borrow a net 11.5 trillion, 11.6 trillion rupees marginally. This is marginally above what it has borrowed in the current year. All these are poll numbers, averages. Let me now invite our guests, Samiran Chakraborty, Chief Economist, India at Citi, and Santanu Sengupta, the India economist at Goldman Sachs. Gentlemen, oh yes, both are Bengalis. Thank you. Shantanu, to start with you, I mean, this fixation with fiscal deficit, I didn't see it in too many foreigners and equity guys. Do you think if it comes at 6 or above 6 fiscal deficit, it would be a serious negative?
Thanks, Lata, for inviting on the show. In terms of the fiscal deficit, our expectation is that we consolidate by 50 basis points to 5.9% of GDP from 6.4 in fiscal year 23. Fully funded by the subsidy reduction. If you want to get to the medium-term fiscal consolidation path, so you want to get to about 4.5% in roughly 3 years' time, then it's important to show at least the optics of getting around that 6% number. I think it'll be less about whether you're exactly getting to 6 or not, but our expectation would be that you get to about 50 basis points of consolidation, mainly through reduction in subsidies, both fertilizer as well as food.
And you would take it very negatively if they didn't, if it stayed at 6 or above 6?
I think at about 6, if you're showing about 40 basis points of consolidation, which you should be able to achieve through subsidies, you're at least showing the right optics in terms of sticking to the medium-term fiscal consolidation path.
Okay. Now, actually, for the market, it's really the price of money. Samiran, your net borrowing is 11.6 trillion. Gross borrowing is a little over 15 trillion. Now, there are some people in the street who are expecting that the gross borrowing could be even 16 trillion rupees. Will this pass? I mean, we could manage it in the current year without disturbing yields. But next year, we are expecting credit growth to grow. Borrowing 16 trillion, can't it disturb the market?
So, Lata, just connecting with your earlier question, I think that's the need for having a lower fiscal deficit number. Yes, last year we could push through a significantly larger borrowing program without too much distortions in the market. But one can argue that that was because of certain one-off things which might not get repeated every year. But having said that, there are a few kind of structural changes happening, which is probably supporting a larger borrowing program. One is financialization of savings, not just for equities, but financial of savings for debt as well, which is coming through either the Provident Fund route or the insurance route and buying these bonds. And the second thing is that the banks seem to be holding on to a much higher SLR ratio than what normally they would be. And that's also another factor supporting the steady bond demand. And last but not the least, there would be expectation that last year RBI did not do any OMO purchase, but in FY24, in the latter part of the year, when the monetary policy stance gets more softer, there could be chance of OMO as well to support a larger than expected borrowing program.
Okay, in that case, they can also do a bit of CRR cut, isn't it? Shantanu, you think these are something that we should figure, calculate in the market borrowing appetite? There is a possibility of OMO, there is a possibility of a CRR cut later in the year?
So we would not really be thinking about a CRR cut, but I would agree with Samiran that especially in the back half of the next fiscal year, when our projection is also that inflation will be coming down and the monetary policy stance shifts. In fact, we have a cut built in the December policy. So by Q4 of the calendar year 23, that is when the RBI will have more degrees of freedom in terms of liquidity management. So it's possible that they come in with some amount of OMO purchases, and also the insurance money that is coming in. So the funds that are flowing into insurance, financialization of savings, as Samiran talked about, that should help the back end of the curve as well. So beyond the 10-year point, that should help. And finally, if you have a global risk on coming on in the second half of the year, you could expect some FII inflow into bonds as well in search of carry.
Okay.
So that should keep the overall borrowing program supported.
Well, neither of you have mentioned the bond index inclusion into JP Morgan or something. I guess that will be able to, allow the government to spend a lot more. Actually, the equity market is not terribly worried if the fiscal deficit were even 6.1 because they don't think these numbers. But Samiran, let me come to the other, the tax assumption number. Routinely, all the economists' notes I saw are expecting it to grow only as much as the nominal GDP. Nominal GDP 10.5, tax will grow by 10.5. This year, nominal GDP has grown by 15.5, taxes have grown by 18 at least, a conservative number. Why can't we assume that next year?
So, Lata, we had almost 2 consecutive years of tax buoyancy to be significantly higher than one. There are good reasons for it. One could be that the formal sector has grown faster than the nominal GDP, and the formal sector is the largest contributor to the tax revenue. So automatically, the tax revenue growth has been higher than nominal GDP growth. And the second aspect could be better tax compliance as data between direct tax and indirect tax authorities get shared. The whole tax revenue buoyancy was shown. But there are limits to extending these logics for every year. So a priori, all analysts would probably start thinking that this is going to be quote unquote a normal year. And in a normal year, the tax buoyancy should be closer to 1. So that's what I think most people are taking at the moment. As the year progresses, we will get a better sense on how these 2 factors play out. It could be that this year there is a little bit pickup in the informal economy from the lows of COVID, especially if the rural economy starts doing well. In that case, we could be right that the tax buoyancy numbers come off in FY24 a bit from their FY23 levels.
Well, there are government civil servants who keep saying that we are better able to net taxpayers because of the GST data, because of spending data. But anyway, let's get to the other big thing. Shantanu, how important is the capex number? The average I got is they will increase it by about 15%. But will it be seminal to growth? Is it absolutely needed for private capex to pick up?
So our assumption is that the government, at least all indications are that they are going to continue with the capital expenditure. So we are expecting it to remain constant at 2.9% of GDP. So we're not really baking in a much higher capex growth number from where we are compared to nominal GDP. It just remains the share of GDP remains the same. The other thing that we figured out by looking at pre-election budget analysis, and we looked at it from FY09 all the way up to FY19, was that in every year before the general election, the government reallocates expenditure under capital expenditure towards infrastructure. So there's a higher spending on roads and railways, mainly towards infrastructure within the capex allocation. We think that if you're going to be on the investment cycle and you're going to sustain it going forward, and the private sector has to be crowded in, it's important for the government sector to continue with the capital expenditure into this year as well, until you have conclusive signs of the private sector coming in and taking over the investment cycle. So we think that the focus is going to be towards about 2.9 to 3% of GDP in terms of capex in FY24 as well.
Okay. Samiran, what can be anything magical? I mean, we always want, say, bank privatization or asset monetization, or even that PM Garib Kalyan Yojana, something outstanding. Is there any magical announcement that is possible within the realms of the fiscal deficit, within the contours?
So we have talked about a few things in our report on what could be the so-called surprises in the budget, and not all of them might have any immediate revenue implications. Like, for example, there could be a pilot urban Narega program. There could be a possibility that we redefine the minimum wages as more living wages, which would mean maybe 15-20% higher growth in the minimum wages. So these are all things which can potentially make the budget look a bit more populist. Although the fiscal consolidation still continues, because these schemes, the announcement of these schemes will have no immediate expenditure implications. But for me, I would rather look at the extent of fiscal consolidation in this budget. According to us, the fiscal impulse has been very strong over the last few years. Now it's the time, in a cyclically adjusted way, to adjust for this fiscal impulse to be lower. Otherwise, there's a risk of current account deficit and inflation flaring up at the back end of the year, which in our view is a more disturbing pre-election backdrop than a slightly slower growth.
Okay, I'm running out of time, Santanu, but would you agree? What would make it a dangerous budget?
So I think the commitment, again, to fiscal consolidation is very, very important. The bond markets obviously will be looking at the overall net borrowing number. But I think from the rating agency's point of view, or from all the macro community point of view, that commitment towards fiscal consolidation, getting it down in that 6 or below 6 handle, and continuing with capital expenditure, and not seeming therefore too populist. So if you concentrate on capital expenditure, you will be allocating less towards the populist schemes. That will be important in terms of as we look into FY24.
All right, gentlemen, out of time. Thank you very much. But that's what we have to look at. Maybe cosmetic populism, concentrate on capex, and be disciplined. The equity markets are not concentrating on that 5.8 or 5.9 number. But clearly the economists are. That's what makes for a winning budget. Wrap up on this very special show. Thank you for watching.